Welcome to my revision lecture on transfer pricing, the basics, and then how it gets tested. Hope you enjoy. So we're going to start with the transfer pricing objectives. We have 4 of them. The first one is goal congruence. You need the divisions to act in the best interests of the company. So you need a transfer price that's set, which makes them work for the business as a whole, not for them as individual divisions. You next want to set a transfer price which fairly identifies their performance as divisions. And so the transfer price needs to be set so it doesn't favour one division over another in terms of looking at those performance indicators like return on capital employed and residual income. You want to promote divisional autonomy. So you don't want to be too prescriptive about what that transfer price is. You'd like them to negotiate with each other to come up with the most satisfactory one between them. You also want to optimise resource allocation. You really don't want some divisions going externally if it's better for them to buy internally. And setting that transfer price is pretty much key to that. Overall, you would like them to motivate the divisional managers. So it's important to have those 4 objectives in mind, but the overall objective is to motivate those divisional managers to make the best decisions for the company. Okay, so now I want to introduce the fact that transfer prices cancel out for the group. Transfer prices are only important insofar as they encourage divisions to trade in a way that maximises profits for the company as a whole. The fact is, the effects of interdivisional trading are wiped out on consolidation. Now, the selling division sales will be cancelled out by the buying division's purchases. All that will be left will be the profit, which is merely the external selling price less any cost incurred by both divisions in producing the goods. This is a really important concept for you to understand. So I have a pictorial representation of this for you here. Here we have alpha, which is the selling division, beta the buying division, and then the company as a whole, which is the addition of the 2. Now alpha is making sales externally to its customers of 1 million. But it's also making sales to B, the buying division, of 2 million internally. It has variable costs of 2 million, so therefore the contribution to it, alpha, is 1 million, and to the company would also be 1 million. Now those sales to the buying division are now purchases from the selling division in Beta's books. Beta then sells externally 6 million and adds those variable costs of 1 million to those purchases from A to therefore get a contribution of 3 million overall. So that will be 3 million to Beta and 3 million towards the company as a total. And so as you can see, the external sales will add up to 7 million. Those internal sales and those internal purchases cancel on consolidation. And therefore all you're left with is the variable costs that both divisions incur externally. And therefore the contribution is 4. So just proving that they cancel out on consolidation. Now let's have a look if we change the transfer price. All that's happened now is alpha is making an increase in sales of 1 million to beta. And beta is now incurring a high level purchases of 3 million now compared to previously 2 million from alpha. But the contributions have changed for the 2 companies. Alpha is now on 2 million and beta is on 2 million. But the contribution as a whole to the company remains at 4 because they cancel on consolidation. So it makes no difference to the company what the price between the 2 is, because on consolidation it cancelled out. The trick though is to set that price so it motivates them both to act in the best interests of the company. And that will depend on what's going on in the external environment, whether there's an external supplier, whether there's spare capacity in alpha, and whether they're able to sell all they can externally before selling internally to beta. So how do we set that transfer price? Well, there's two approaches. There's the market-based approach and the cost-based approach. Market-based approach focuses on the external price. So the selling division gets the same profit on internal and external sales. The buying division therefore then pays a commercial price. Now that commercial price would probably be minus any savings in selling and distribution costs that the selling division doesn't have to incur because they're selling internally. Cost-based approaches, there are three. So there's the variable cost approach. Now, unfortunately, this won't cover fixed costs of the selling division. There's the full cost approach, but therefore then there's no profit margin for the selling division. And then there's the full cost plus a markup, which will realise a profit for the selling division. So those are your two approaches, market-based and cost-based approaches. So when we're looking at exam questions, you need to focus on two things. What's the minimum acceptable to a seller, and what's the maximum payable by the buyer? Now, the minimum acceptable to a seller is something called the marginal cost, which is the variable cost, plus the opportunity cost. We'll look at that in a minute. The maximum paid by the buyer will be the external market price always. So the minimum price, let's look at this in a bit more detail. It's the marginal cost, variable cost basically, plus the opportunity cost of an item transferred. Now the opportunity cost is the maximum contribution foregone by transferring internally. So if you've got spare capacity and limited external demand, then there's no opportunity cost. So it's just the marginal cost. Now remember, this is the minimum price. It's not the actual price which you may negotiate with your buyer and seller, right? It's the minimum price acceptable. Now if there's no spare capacity, or not enough to satisfy internal and external demand, then there is an opportunity cost. And the opportunity cost is the lost contribution from external sales. It's not fair to ask the selling division to sell internally and then lose contribution to their performance from those external sales without getting satisfaction for that, which is that lost contribution, that opportunity cost. Now the maximum price, as I said before, is always the external market price. But in a negotiation, it could be negotiated to the lowest external market price minus any internal cost saving on packaging and delivery. And that's probably something that you'll be looking at in section C questions, that lowest external market price minus the internal cost saving. In MCQ questions, it will tend to always be the external market price. Okay, so I've now got a case study to run through with you. And this will explain all those little idiosyncrasies that can come up in exams in the different ways and how you're supposed to deal with them. So Alpha and Beta are divisions of Charlie Company that manufactures e-bikes. Alpha makes the motors and Beta the bikes. They operate autonomously, however it's the company policy that Alpha should supply motors to Beta first before externally selling. Okay, so let's have a look at the numbers in my example for Charlie Company. Here we have Alpha and Beta. Alpha has a capacity of 75,000 units, 75,000 motors. It's got an internal market with Beta of 45,000 and an external market it can sell 30,000. Now notice that 45 plus 30 makes the 75,000 full capacity for Alpha. The sales price is 540 and that's what it can do to sell externally. and it's got a variable cost of making those motors of £350, but it's got variable selling costs of £50 to sell externally, not internally to beta. Overall, there's a contribution of £140 for external sales per motor. Now, beta is able to source the motors from an external supplier at a cheaper price than alpha's external sales price. So that transfer price can either be set at £540, which is the external sales price, the variable cost of the motor, which is £350, which would be the minimum price, or it could be set at the external supply price of £480. It's all a matter of negotiation, and the minimum contribution, if they bought from an external supplier, that beta's going to get is £970. So here now we're going to be looking at the numbers of the two divisions based on the fact that Division A has spare capacity and a minimum price should be set. So if we look at Alpha's profit statement here, all the external sales are supplied first, and then this leaves enough spare capacity to supply beta. We will supply beta the 45,000 that they require at the minimum price of £350. Now this is the marginal cost excluding the variable selling costs, and therefore the minimum price. The sales from B and purchases from A cancel on consolidation, and the overall profit to the company is £33,450,000. Now this is because Alpha has spare capacity and so has no opportunity cost to sell at marginal cost to beta. However, is this fair? Beta would have to pay £480 to get the motor externally. But from the company's point of view, the transfer price is cancelled on consolidation, so it doesn't matter. There's spare capacity. Alpha's managing to supply all the external market and the internal market. So in reality, Alpha will be disincentivised really, and beta will be totally incentivised. So really there does need to be a negotiation. Alpha is only making 4 million as opposed to beta making 29 million. Should we be creating a fairer performance management with those transfer prices? So now we're moving on to the numbers, changing the scenario now to have no spare capacity in Alpha. So now Alpha has 50,000 potential sales in the external market, which means that if they supply internally first, 20,000 external sales will be missed for Alpha and the group. Remember, those external sales will add contribution to the group. So here we're going to look at the numbers based on supplying internally first with no spare capacity. So the internal market is supplied first. Now the external market is therefore only going to be getting 30,000. So there's 20,000 of the 50,000 now unfulfilled. Lost opportunity. So the transfer price now needs to be set based on that lost opportunity. So the marginal cost transfer price originally from the previous example would be unfair, as there's an opportunity cost of 140, being the lost contribution from external sales. So now the transfer price is therefore set at 350 plus that lost opportunity of 140, which is the 490 that you can see. Now please notice it's the same profit as before, but is it a fairer allocation? Alpha will be disincentivised if forced to sell at marginal cost now, but beta won't pay above 480 as that's the price from the external supplier. Now this is where your capacity is limited. So really the minimum price that Alpha will accept is the marginal cost plus the lost opportunity. But beta are not likely to go for the 490 because they can get 480 elsewhere. So the compromise might be a market-based price. Here the price is going to be set at $4.30. So that is the minimum external market price less any variable cost of selling to the external market. So that would be the $4.80, which is the minimum, minus the $50, and that makes $4.30. Here again the results in the same contribution overall to the company as before, the $33 million. Alpha and beta will now negotiate a price within the range $350 to $4.80. It makes no difference to the company. The key is for them both to be incentivised. And this is where there's no spare capacity. So I've gone through all the three options, the marginal cost plus the opportunity cost, and now the external market price. We're now going to change the scenario. So now the company now decides to let the division source products how they want and set prices by negotiation. What would be the best for the company now, therefore? So what we've got to do now is do what is best for the interests of the company as a whole. Here, Alpha now sells all it can externally to get the $140 in contribution per sale for them and the company, remember, and the company. As there is an external supplier, Beta is able to take $25,000 of spare capacity from Alpha and get the remaining $20,000 externally at $480. So what's happening here is we're selling an extra $20,000 externally through Alpha, making $140 contribution, and sourcing $20,000 externally for Beta at a higher cost than our marginal cost. But the point is we're actually making more money that way for the company. So by changing the policy, there's now an increased contribution to the company. We've increased the contribution via Alpha and reduced it via Beta, but overall it's a win-win. As the increased contribution of $140 is offset by the increased variable cost of $130, there's an extra contribution to the company of $10 a unit. And that is 10 times 20,000, which will be 200,000. So long as there's an alternative supply for motors for Beta, then Alpha should actually satisfy all external customers first, therefore, because this will give an increased contribution of 200,000. So that's what's doing best interests of the company as a whole. So now I have a flow diagram for you, and this will help you with exam questions. It's all about working out what the minimum transfer price would be. So if there's only an internal market for that selling division, then absolutely it's marginal cost. They're effectively just a cost centre. But if there's an external market, it depends whether there's spare capacity or no capacity. If there's spare capacity, then it's the marginal cost, as the opportunity cost is zero, but you are likely to negotiate some sort of cost markup, don't forget. But remember, this is the minimum price. If there's no spare capacity and no external supplier, then the minimum price will be the marginal cost plus the opportunity cost, due to the loss contribution on external sales. If there's no spare capacity and there's an external supplier, then the price is the external price less the variable cost of selling. That's if the external supply price is cheaper than the selling divisions. Now in reality for questions, these two will equal, because the marginal cost plus the opportunity cost will equal the external price less the variable cost of selling, as long as the external price is the same as the one that the selling division would do to the market, and the external supplier would therefore be the same price. So there's your flow diagram for your minimum transfer price for those MCQ questions. You can also use this for your section C questions. So you can have this in your mind, and so that you can go through all of the options and get those application and implication marks in your exam. Okay, so now I have an opportunity for you to have a go at using my flow diagram. Here's a question for you. What should be the minimum transfer price per unit for component X in this situation? In a company with a divisionalised structure, Division A transfers its output to Division B. Division A produces just one item, component X. Division B makes and sells an end product that requires 1 unit of component X. Now in Division A, we're given all these various different prices on costs. There's a marginal cost of production of 8, a fixed overhead cost of production of 3, a market price in the external market of 16, and then variable selling costs to the external market 2. The point is you need to read further on in the scenario to make your decision. What should be the minimum transfer price? So if you have a look at the red, it says Division A is not working at full capacity. That means it has spare capacity and it can meet the full external market demand and the demand from the Division B for all internal transfers. So remind yourself of my flow diagram. They have spare capacity. Therefore, what is the minimum transfer price? Okay, so I'm going to show you the answer. So the answer is the marginal cost of production would be the minimum transfer price because they're not working at full capacity. Incidentally, the maximum price would be the 16, which is the external market price. Now I'm going to do the question again, but change the scenario. It's exactly the same question, but in red now, Division A is working at full capacity and it can't meet in full the external market demand and the demand from the Division B for internal transfers. So what should be the minimum transfer price per unit for component X in this situation? Again, go back to my flow diagram and have a little think about what that would be using that. And so here the answer is, the marginal cost of production now is 8, but we have to add an opportunity cost, which is the loss contribution from selling externally. And that's because they're working at full capacity. And that opportunity cost would be the market price, less the variable cost of production, less the variable selling cost to the external market, which would be 6. So therefore, the price will be the marginal cost of 8 plus the opportunity cost of 6, which is 14. This is exactly the same as the external price minus the variable cost of selling, which is the 16 minus the 2, and that is also 14. So that's what I said on my diagram last. I said that sometimes those prices will equal, and that's when the external market price is the same. So hopefully you got both of those correct. So that's it. I hope you enjoyed the lecture. Please get in touch for my ACCA PM courses on my WhatsApp. That's +44 7531 867 647. Or you can go to joetuffle.co.uk, which is my website. Happy revising!